I don't think, however, that this is the start of a major correction. I think it's a pullback.
Mike McGlone, Senior Commodity Strategist, Bloomberg Intelligence, all the way over in New York. Mike, the infamous stimulus seems to be continuing to prop up the market, but also some sort of bullish news overnight, more on the vaccine. President Biden is sort of committing to having the vaccinations available for everybody in America by July.
Well, that's the hope, that's the optimism, just like all this optimism for demand, like you had in your first headline. And I like to point out that the trend in demand estimate revisions was bearish before COVID. And I liked how Vandana pointed out, we've had this spike in the market. I view the Texas freeze spike very similar to the attack on Saudi oil assets in September 2019 in a very similar way. Brent peaked around 72 then. I suspect it's peaking around 67 now. And I think it's a very good opposition to last year's low. So I think we're putting in a pretty good high, partly because what's happening here, and I think it's everywhere, as I mentioned with Christopher, even though people can and will, we're getting the vaccinations, we have shifted forever from people not going back to the office. I mean, that's forever. It's not as much. I mean, for instance, my office, we've been encouraged to come back. It's safe, and just 3 to 4% have come back. So we're not going to be driving as much. I do know that
there's lots of good coffee in that Bloomberg kitchen.
But they're not. That's the thing. People aren't coming back. So I just look at the simple facts: is cost of production, the U.S. shales dropped to the lowest ever. There's a little bit of incentive to produce. I look at a simple, also factual metric. Producer supply is going to be coming back strong. I look at commercial hedging. It's right back up to near it was during the 2018 peak in prices. And then I look at OPEC spare capacity. It's about the highest ever. And we all know what's happening. Vandana and Christopher mentioned that. They need some money. So I'm not worried. At these levels, I think crude oil's going to be doing what it's been doing. It's going to peak. It's near the highs. It's near the upper end of the bell curve. It has been for the last 5 years. It's more likely to drop from these levels.
Let's welcome Christopher Haines, Global Crude Analyst of Energy Aspects. Welcome, Chris, to the table for the first time. Nice to have you. We're kind of been juggling the glass half full, glass half empty metaphor for some time. We thought we had broken out of it to being sort of more on the full side, but where do you see the market at the moment, given the dynamics and with OPEC set to meet on Thursday?
Yeah, thanks. Good morning, Sean, and good morning, everyone else. I think, we've come a long way already. So, if we're talking about glass half full, glass half empty, I think we've probably gone slightly beyond that. We were looking at, sub $50 not too long ago. So that's, certainly a big uptick. Couple of things that I'm concerned about is just how much of the demand increase that everyone's talking about is already priced into the market over H2. And then right now, I think everyone's a bit tentative just because they're waiting on that OPEC decision. And that's really what's going to be key for this week, I think.
And what's your own sense about where OPEC Plus should go? Where is the demand recovery, do you think, looking into Q2, Q3 for OPEC barrels?
I think it's going to be all over the world. I mean, most specifically Asia. I think, currently they're going through a lot of refinery turnarounds. So you are going to see more demand there, definitely for May and June barrels. And they're going to be kind of starting to ship in April. Europe needs to start coming back. The vaccination programs are slow, but they're still starting to come out. We're seeing some positive signs in a couple of countries. And then you look at the Gulf Coast and it's screaming out for sour crudes. So, I'd imagine that some goes there. I think everywhere seems to need some oil at the moment.
Vandana, we had a pretty strong interview that's being published after this show with the spokesperson for energy for the BJP in India. He didn't mince his words about how fabricated the current oil price is, noting that there's 8 million barrels of idle oil supply. This is a politically choreographed price point, not a demand supply scenario. If you pumped the available oil in the world today, prices would be very, very low, just like any other commodity, unrestricted. India's getting a little cross.
more than a little cross, one would think. It's a very unique perspective of a relatively price-sensitive, major third largest oil consumer in the world, major crude importer, growing needs, but also very importantly, and I'm not sure if Mr. Taneja mentioned that in your interview, it's a kind of politically sensitive topic, is that the government utilized the drop in prices over 2014 to 2016, and then again in 2020 to steadily ratchet up over several iterations the taxes, the central hoard of central government taxes and state taxes on fuel prices in India. And that is the main reason that diesel and petrol prices have hit all-time highs in India. I mean, you look at crude, it's nowhere near all-time highs, right? So it shouldn't have been that way. But so there's a tussle in the Indian government. There you have the oil ministry, which is having to defend, and people are asking the oil minister, "What are you doing?" And he says, "Look, I'm asking my peers in OPEC to open the taps." And then you have the finance ministry, which holds the budget strings and which makes decisions on taxes and so on. So there's a tension between the two. There are some rumors now that maybe the finance ministry will relent and ease the taxes a little bit, and that's what is needed, I think, right now to give some relief to the consumer at the pump in India.
Mike, the sort of big annual gathering of a U.S. energy industry, oil and gas in particular, is taking place this week, CIRA week, virtually. But it does appear that it's sort of, there's many things being said. One notable recurring statement is shale isn't coming back in any way like it was. Even those Chevron and Oxy, who control a lot of the Permian, are stating that as well. Can OPEC move forward bravely with new supply, relying on those kind of statements that shale is indeed not going to be rushing back like in previous cycles?
Well, I love those narratives. You look at the facts. Commercial hedgers cannot hedge unless they have supply, and it's near the highest ever. I just look at the futures. I've enjoyed, this is a narrative I used a lot in 2018. In fact, I used it too much that some of the producers on TV at Bloomberg started getting upset with me, but it worked. It was just a clear indication. If you're a producer, you don't hedge as a commercial seller in futures at near the highest level ever unless you're going to bring on supply. So that supply is coming back. Remember, it's only been a few months. It's not gone. And also there's a simple profit incentive. The average cost of shale production right now is below $40 a barrel, and they are able to sell forward almost near 60. Do the math. It's simple, as we all know in commodities. If there's a higher prices is the limit here. So I look at the key fact in crude oil for the last few years is supply elasticity is absolutely increasing rapidly, and demand is dropping incrementally. So I expect that supply elasticity to come back. We need some kind of shift in what's happening with technology and innovation for that to reverse. And I think it's very incorrect to say that supply is not coming back. And I'm almost certain the demand's not coming back, partly because demand was stagnant before COVID, at least in this country.
Chris, I know you're a close watcher of the North Sea basin. We talk a lot about the US and then flip over to the Middle East and so forth, often forgetting the likes of Norway and others that are fairly significant producers. Norway has a massive field there that's at 500,000 barrels or so a day. So how is all of this recovery, let's say, impacting the North Sea basin and the industry in general in that area?
So I think North Sea is always the one where things start to clear up, because you have initially the pull from Asia. US is increasingly more of a push barrel into Europe. So once Europe starts to look a bit stronger, then you've got a decent picture that the whole world's doing fairly well. So I think at the moment, we're not quite there yet. One thing that is interesting is that we have seen, at least from our tracking, 3 consecutive months of stock draws. And that's the first time that's happened since 2016, at least for Q1. So things are looking pretty positive. Obviously, you've got that extra spike from the US freeze-offs that cut a little bit of oil into Europe from the US, but that seems to have come back now. So what we really need, just to to complete the picture is for European demand to come back, for the vaccine programs to kind of roll out, become more effective, and for lockdowns to ease. And I think at that point, we're going to be looking pretty strong across the globe.
Vanda, another point you made in Vanda Insights today was drawing everybody's attention to the volatility in the financial markets that's spilling over into the oil markets. How do you see that correlation moving forward into the second quarter on the other side of the OPEC decision?
Yeah, so as I've mentioned, there's been three props to crude's rally that we've seen, especially since the start of this year. Fundamentals, I think fundamentals remain quite sound, and of course we'll see. Hopefully, OPEC Plus does not undo the advantages it has had so far. There's been financial markets, and I think financial markets have played quite a major role. I've mentioned a bit of, I think there's been a bit of an echo chamber effect. We've had, a rash of banks and some prominent trading companies revise upwards their calls for demand, but more eye-catchingly for prices, right? We've seen predictions of $70, $75, $80 and even higher prices. So,
it's clear all of the banks are long on this market, and to a great extent, one has to be cautious of them talking up their book.
Yeah, exactly. As I have mentioned, so we have to, and then almost coincidentally or not, there's also been a talk of, are we in a commodity super cycle? Now, I don't think we are. We will probably not have time to go into all the reasons there, but, I think China and Chinese demand recovery is probably being overestimated and overstated.
And there does appear to be a little bit of wobble in the data there at the moment that we've seen, the last few data points at least, to support that point you make.
Yeah, China's not going to, look, I don't expect them to go and buy crude like there's no tomorrow, like they did last year, when prices were $30 and below. So now they come back from Lunar New Year. Of course, the refineries in the country are going into quite a heavy maintenance season as well over March and April. But even looking beyond, I don't buy completely into the China growth story. We had the head of the Chinese banking and insurance regulatory body yesterday rattle the markets as a matter of fact. He said, he expressed grave concerns over what he called a bubble in the global financial markets and in the Chinese property sector as well. So overall, financial markets, I think there's been a lot of euphoria. And of course, the US stimulus has played into it. But, as we saw last week already, the crude market, the sell-off that started, diverged quite sharply from the continued optimism in the stock market. So what I would say, I tell my clients is to be a little bit cautious. All this euphoria, the continued new highs in Dow Jones and S&P 500, at some point it will diverge from crude, because crude will be grounded in fundamental, basic supply-demand realities on the ground.
Mike, one of the things that took us into this current cycle, if you like, 12 months, was the collaboration between Russia, Saudi Arabia, but also America. The US White House was very involved in choreographing the move to reduce supply and stabilize oil markets. I'm wondering, as OPEC Plus go into this meeting on Thursday, how politically sensitive, or where does America stand, the new body politic in Washington, towards big efforts to raise oil prices at a time, indeed, when Main Street in America is still hurting quite significantly, which is why they're working on a $1.9 trillion stimulus package?
I think the tone of your question really answered that really clearly. It's a complete shift here. The primary focus of the new administration is clean energy, decarbonization, electrification, and it's going to be more than you expect. I used to own a farm, so we fully expect massive pickup in use of biofuels, ethanol, biodiesel, and a big and major subsidies for EVs and solar panels, of which I have and I've used. It's a complete shift. And I think what's the difference is the Trump administration tried to arrest a trend that was already shifting, that's away from fossil fuels. And the Biden administration is accelerating this trend towards innovation, decarbonization on a global scale. And for instance, the estimate from Kathy Wood, who I interviewed last week, is that the average cost of an EV in this country is going to drop to $18,000 in 5 years. And currently it's too expensive. That's just a simple trend that's been accelerated. So I look at the key bane to commodity investors in history has been massive innovation. And we're in that acceleration stage at the moment. And
I mean, given that,
so
you might say that Biden might be supportive of higher oil prices to ensure that the green side becomes economically attractive.
Well, that's the key thing about it, is that's not going to go over very good politically. Green side's happening without it. That's my key point, is we have this massive supply elasticity. And despite the fact weren't getting higher prices, the green revolution is accelerating. And this is just making it more so. So I view crude oil as very near the upper end of the range, sticking into a long slog. And the average price for the last 4 or 5 years, the mean has been around 50. And Brent, and I fully expect to gravitate towards the apex of that bell curve of prices around 50.
Chris, I think OPEC Plus is doing a pretty good job keeping us all guessing only 2 or 3 days from a major meeting. Usually we would have a pretty good sense at this point as to where the next supply decision is going, but it is indeed pretty uncertain. Will Saudi bring its million back? Will it bring it back in one go? How much will the rest of OPEC be allowed to increase? Will they increase at all? I mean, there is, and yet the market demand recovery seems to be a little bit uncertain too. We're going to kind of put everybody on the spot now to give us their calling of where they think OPEC needs to go on Thursday.
So from my, at least from Energy Aspects point of view, we're expecting Saudi to bring back that million. They've been pretty clear on signaling that. They said the voluntary cut was purely for February and March. So there's nothing to suggest that they won't. The only thing that might alter that is, whether they're just a little bit worried about the pullback in prices that we've seen, and whether that just forces them to stagger that increase perhaps over April and May. In terms of the rest of OPEC Plus, we're expecting the 500,000 barrel increase in April and again in May, but that is going to be minus the volumes that Russia and Kazakhstan had already been given, because they kind of had a early start with their increases. So we're expecting about 1.5 million back in April.
Let's go to the survey question to give everybody in the room a chance to weigh in here on where we're going next. What will be the average price of Brent crude oil in the second quarter? Closer to 70, closer to 60, closer to 50? Where do we think we're going? We kind of went from closer to 50 in Q4 to closer to 60 in Q1. Are we going to keep the trend and going next quarter closer to 70? Some have called that, Goldman Sachs and the other banks, as we mentioned. Are they talking up their own book? Are they not? Where does the room think we're going in Q2? Looking forward. Vanda, your thoughts looking at the big decision this week for OPEC Plus to make. What do you think they will do? Where do you think the market is demanding they go?
So in your question to Chris, you said, what does OPEC need to do? And I was kind of hoping you will ask me, what does it need to do? Because as we all know, guessing.
I want some wills. I want some wills here.
Okay, so my base case scenario is an increase overall between the Saudi unilateral cut being ended and the rest of OPEC increasing. An overall increase of anywhere between, I would say, 800,000 barrels per day to 1.5 million barrels per day. So basically, I am assuming 500,000 barrel per day increase from OPEC Plus. I think that's probably the best way for them to go as well. Prices have risen. Demand is looking much better than it was when they met back in January. I think the consumer nations need a bit of relief right now from prices as well. As for the Saudi cut is concerned, I think, that's the ace they have up their sleeve. They can say that perhaps April is not the best time to bring that entire 1 million back into the market. So they could stagger it over 2 months, 3 months. We get maybe staggered 300,000 odd or a third of a million back each month, something like that. So that's why I'm putting it in the range of about 800 to 1.5.
I suppose a lot will depend on whether they will have sensitivity regarding their Asian customers as they recover from the COVID crisis over the second into the third quarter. Is Asia, obviously China's looking pretty solid. India, as we said earlier, a little bit vulnerable. Are other Asian customers seeking a bit of relief from OPEC on this occasion? Should they be concerned?
I don't hear anything as loud and incessant as the demands that we have had from the Indian government and the oil minister. But, as I mentioned earlier, China is, obviously we never hear Chinese leaders coming up on the international arena and saying anything about oil prices, but we know they are price sensitive to an extent as well. They're going to buy just in time and just what is needed for the refining needs, at current prices. So not much. I think more than Asian customers, I think OPEC needs to keep an eye on what 65 and 70 and above prices might do to shale. I think that should probably be a bigger consideration for them.
Let's go to the survey result and see what the view in the room is on the direction of travel. Okay, everybody's playing it safe, closer to 60. Mike, your thoughts on where we will go this week, and also I'd welcome your commentary on the decisions in the US regarding Texas is going to completely reopen in the coming week. We're starting to see other states sort of going with the idea that we're ready to open up the economies in America, despite COVID still being an issue of concern, according to the CDC.
Economies are opening up rather quickly. Texas is going to learn a lesson that I knew growing up in Chicago. You got to insulate your pipes. It's not that complicated. So there's demand for copper, demand for metals, and I'm bullish on metals. But people aren't going to be driving the way they used to in this country where people love to drive ever. It's just a shift. I've seen it everywhere. I'm shocked my colleagues are not coming back to the office, hopping in that car, driving their average 40 miles a day to and from the office. It's just never going to happen, never going to come back. That's a change forever. And the point is, it was negative before. And I like what Vandana said, is OPEC knows it. Shale production's coming right back. They're smart enough to look at commercial hedging. It's just that supply is guaranteed. It's coming back. You don't hedge unless you got supply. So this is a conundrum. It's why the thing I see about energy stuck in a narrow range for a long time, and why I'm bullish on metals and bearish petroleum.
I suppose on that point, Mike, it's a matter of when is shale in that regard going to come back, and that given the narrow corridor that the likes of Oxy and others have at the moment in terms of capex expenditure, they can't afford to get the call wrong timing wise, given their fragile financial position.
Just like OPEC supply, it's not an if, it's a when.
Yeah, well, it's sitting there, 8 million barrels of it ready to go.
Burning a hole, and they need the cash.
Chris, Europe, of course, seems to be a tale of two cities in some regards in this final stage of coming out of the dark forest of COVID pandemic. UK, for one, seems to be in the good side of the fence, whereas the rest is uncertain. What is the outlook, do you think, for second quarter recovery in Europe?
I think it'll be pretty slow in the second quarter. I mean, you're certainly seeing, that evidence that, the lockdowns and vaccination rollouts have been effective in the UK. But I think, as you mentioned, other parts of Europe are a little bit more behind there. And what we really need is that pickup in both, all of the personal mobility fuels, so gasoline, diesel, jet, because that's really what's going to get refiners running again. I'd imagine to see that start again, when the weather gets better, May, June, and, particularly over the summer, I think we could start to see more of that happening. I think there's still a lot to work out with how travel is going to work, who gets a vaccine passport, or if you're even allowed one, what kind of restrictions countries are still keeping in place. But nevertheless, I think over the last 2 to 3 months, European demand has surprised us to the upside. We're expecting much worse data out of Europe. So I think, we are in a stronger shape, and I'd say Q2 is not going to be mind-blowing, but by the time we get into H2, things are going to look much better.
The other data point, Chris, that OPEC Plus will be looking at quite closely, as they always do, is the trajectory of global inventories. That is ultimately their target, the infamous 5-year average, landing somewhere near there. And that is expected, at least forecast by OPEC IEA, to be getting there in the second quarter. How does Energy Aspects see the landing at the 5-year average on global inventories?
So we don't tend to look at the 5-year average so closely, because I think if you look at the entire refining system, that's grown pretty significantly. Plus, we had a bit of a skew from last year, given the massive amount of stock build we saw, particularly over H1. It's about 700, 800 million barrels of crude. But I think, we're not expecting that, should we say, normalization from early 2020 levels. We're not really expecting that until the end of this year. So we still have a fair amount of stock to work through. China in particular has, they bought so much during the period of low prices. And that's the leverage that they're using now to play the market, essentially. They have crude in storage. So if
they basically went from 90-day cover to about 100-day cover over the course of 2020.
Exactly. And, some of that is because they did expand both storage and their refining sector, but it also gives them an incredible amount of leverage, especially in the run up to OSP announcements. So they can, really try and force that cheaper price.
Okay, well, I think we will leave it there. Thank you, Chris, for joining us today. We welcome you and welcome you back, inshallah. Mike in from New York and Vanda in from Singapore. Really welcome and thank you for your insights. Of course, a big week with OPEC meeting on Thursday, and we will have to wait and see where that goes. But every tea leaf will be read between now and then. Have a good day, everybody. Have a safe day. That's tomorrow, actually, isn't it? Thursday is tomorrow already. The week flies by. We're already in March. Take care and thank you very much.
Bye. Thank you.
Thank you.
Thanks,
Bye-bye.
bye.